Hi, my name is Jamie Pripp, and in this video today we're going to talk about annuities and why they receive favorable tax treatment. Excited today to have Jennifer Wick back with me to do another video. Hopefully you've checked out the other video we've done together. If not, we'll put a link to that in the description of this video. But welcome back, Jen. Great to have you.
Thank you. Super excited to be here. Appreciate you having me.
It was fun doing it last time, and we went over kind of just I think the basics of how an annuity works, and so I wanted to have us get together again today and talk about the tax benefit, so to speak, of annuities. I know that there are people who are interested in understanding why are annuities given certain tax benefits, and so that's what we're going to talk about in today's video. If you are watching this on YouTube, wherever you're watching, make sure you subscribe to the channel and hit the like button. If you have questions, you can leave them in the comments below. So let's dive in today and talk about probably one of the most common questions, and that is, are people responsible for taxes when they have an annuity?
Sure. Yeah, and great question. So number one, the answer is yes, they are responsible to pay taxes. However, there's a lot more to that.
Sure.
So it depends on the source of the funds and what type of money we are putting into the annuity. Annuities are really known for their tax deferral on any of the interest that they earn while the money is inside the annuity. Once they start withdrawing the money, that's when anything they haven't already paid taxes on is going to be taxable. So you know, if you're putting in pre-tax dollars, all of that money is not taxable while it's in the annuity, nor is the interest that it earns. If you use after-tax dollars to fund the annuity, that'll never be taxed again when you take it out, but the interest that it earns is going to grow tax-deferred until distribution.
Okay, awesome. So there's not like a danger of being double taxed?
Absolutely, correct. Yep.
So one of the things that happens for me working with as an insurance agent, specifically with Medicare, people have not great information that they sometimes, I mean, friends and family can be a great resource, but sometimes you can get bad information as well. And I think the double tax thing is one of those things that people have concerns about if they're looking at doing an annuity. So you're saying that's not possible? It's
not possible unless the annuity gets structured and set up incorrectly.
Sure.
And that's when it comes down to signing application and knowing where those funds initially came from.
Right.
Yep.
And we know how to stay in our wheelhouse. So we always, in both of our situations, always say it's always good to speak with a tax professional, CPA, about specific questions related to that. So another question that people have is, how do taxes work in distribution of an annuity? That's a common question that people have.
Yes, yes. So kind of to piggyback on what we just mentioned, number one, it's back to what type of money we're using to fund the annuity. So we can use pre-tax dollars such as like money from a 401k, money from an IRA, or we can use post-tax dollars. It's money that you've already paid taxes on that it's probably parked in your checking or savings account. So looking at that, and then again, back to the tax deferral piece, while it's in the annuity, regardless, all of that's growing tax deferred. You're not going to pay taxes on it like you would a CD. All the earnings you get every year are going to stay as earnings, not taxable, but once you start withdrawing is when it's taxable.
Okay.
So depending on how you withdraw and what type of money it is, it's going to be taxed in the year it's taken out. And so there's several different ways to distribute money from an annuity. One way is take a lump sum, and if you take that lump sum and there's anything taxable, it's all going to be reported on a 1099, which is a tax form that you would file when you file taxes. Or you can take it out piece by piece. And if you take it out piece by piece, there is this rule with annuities, it's called LIFO. LIFO, L-I-F-O, which is last in, first out. So meaning the interest that you earned was applied last to the annuity on top of what you put in. When you withdraw it and take out little pieces over time, they're gonna pull the interest first. And this would be in regards to, of course, more so the after-tax dollars, right? Because eventually you'll take interest, and eventually you're gonna hit what's called the cost basis. That's the money that you put in that you already paid taxes on.
Okay.
Alternatively, when we're talking IRA money, 401k money that we're using to fund the annuity, well, that's all money that's pre-tax that you never paid taxes on. So you put that into an annuity, you're gonna have interest on top of that. None of that's taxable again until you start withdrawing it. But once you start withdrawing it, whether it's a lump sum or piece by piece, it is all taxable.
Okay.
There is another way to distribute money from an annuity, and this is dating back to when annuities were first, I guess, derived, and what they're known for initially is, annuitization, and that's basically a contractual payment arrangement that you agree to with the company, where you would pull your money out over a set period of time, whether it's a 10-year period, a 15-year period, a lifetime. And what they do is they take your money. You agree to this contractual period, they add interest to that, and then you get basically a paycheck for that period of time.
Okay.
And when you do it that way, back to if it is after-tax money that you use to fund it, each payment is going to consist of part principal, money you've already paid taxes on, and part of that interest. And that's a great way to spread the taxation out.
Okay.
But again, with qualified money, such as, that pre-tax money, that IRA, that 401k type of money we've never paid taxes on, if you annuitize, well, again, remember that's all taxable because you never paid taxes on any of it.
Sure.
So if you did annuitize, well, every single paycheck is all taxed at ordinary income tax in the year that you distribute.
Okay. So a great question that came up when you were saying that is just a simple question. What is the difference between qualified and non-qualified annuities?
Yes. So looking at that, when we're talking about an annuity, first of all, an annuity is just the vehicle, like you would put money into a mutual fund, right? Or a CD, or a savings or a money market. That is just the vehicle. Within that vehicle, it still has to have a tax registration. What is the source of that money? So when we're talking about qualified or non-qualified, let's break it down. The easiest way I've explained it over the years that seems to resonate with people is qualified money is you're qualified to pay taxes on those dollars. And qualified money is that pre-tax money that we've been parking away and avoiding paying taxes on through our working years, money that you plug into your 401k or money that was in a pension for those that have pensions. IRA money, right? We can deduct that from our adjusted gross income, right? And that's what's considered qualified money versus non-qualified money. So non-qualified money is you're not qualified to pay taxes on that, right?
Gotcha.
Because you already did. This is your post-tax dollars, money that we've been chucking away in our savings account. A lot of times that's money that people put into a CD, right? You've already paid taxes on that. You've been saving that aside. That is non-qualified. Now that you can fund an annuity, but again, back to anything you earn on top of that, that's what's taxable, but never that basis that you put in, that non-qualified money, post-tax money.
Sure. Awesome. So if you have an old annuity, you could exchange it for a new annuity, for instance, for a better rate, or what are some reasons that people take an old annuity and exchange it for a new annuity? Is it just rates, or are there other reasons?
Several reasons. Great question, and a huge opportunity for you as the client to take a look at. If you have existing annuities, I definitely would encourage you to talk to an insurance professional or financial professional and say, hey, let's take a look and see, is this annuity really working still for me and giving me the greatest benefit based on what my current or future needs, wants, and goals are? So number one, first and foremost, you can always take an old annuity, whether it's non-qualified, which is post-tax dollars, or qualified, which is pre-tax dollars, and you can move that on a tax-free basis to a new annuity with another insurance company. And you can do that with life insurance as well as annuities. The why, and diving into that is, in some cases, these old annuities, it would be the rates that they were offering. We just came out of the lowest interest rate environment we've ever been in over the last 15 years. And now interest rates have been rising. And so, yes, when you dive in and look at what rates are being offered, whether it's an index annuity or just a fixed annuity, those rates that they were offering then are much more attractive now.
Sure.
So we could definitely take advantage of greater growth opportunity with better rates that are being offered. Income benefits. So you can use an annuity and set an annuity up to create your own self-funded pension. So people love pensions and they love Social Security. Well, guess what? That's basically an annuity.
Sure.
You can do the same thing with an annuity on your own and really tailor it specifically to what you're looking for and what you want. So if it didn't have an income benefit, we can look at moving it to something and adding an income benefit. The other little hot button lately is long-term care. Long-term care benefits now have been incorporated, and I shouldn't say now, they have been for a while, but they look a lot different than they once did. There's now what's called asset-based long-term care annuities and life insurance policies. So you can take old annuities and move into these asset-based long-term care policies. And there's even greater tax benefits there when we're looking at non-qualified assets where you can really get around all of the taxes if you use the long-term care benefit.
Oh, okay.
So that's another topic we
That's
might
good
need
to
to
know.
dive into
Yeah.
at some point, right? Everyone's looking to say, how can I save money on taxes? So yeah, ultimately you're looking at, okay, can I get additional benefits that aren't currently offered? Or maybe lower costs if you have an old variable annuity and you want to move it to a fixed or fixed index annuity. Ultimately, you're able to really lower those costs that you're paying, going from a variable to a fixed in a lot of cases.
Okay. So 2 more questions that I have just for our interview today, and that is, in the event of death, do beneficiaries pay taxes from an annuity?
Short answer, yes, they do. The one benefit as far as being a beneficiary in the event of death is that the IRS does impose an early withdrawal penalty if you take distributions from an annuity under 59 and a half. And again, that's an IRS rule, not a company rule, not a carrier rule. Are there workarounds to that? Yes, there are. Talk to a tax advisor. However, in the event of death, the IRS says, that was not in your control. You are a beneficiary of this particular plan. We're not going to penalize you and tax you additionally to take these distributions under 59 and a half because you don't really have a choice.
Sure.
I mean, there's different options, and we won't get into those details, but definitely something to be aware of that, you don't have that additional penalty, although you will still be taxed based on the type of, money that was used to fund the annuity.
Okay. And then the last question I have for our video today is talk a little bit about required minimum distributions.
Yes.
We call them RMDs.
Yes, RMDs, MRDs, required minimum distributions. I've heard them, referred differently depending on who you ask and who's talking about them. Anyway, so required minimum distributions, or RMDs, are it's an IRS rule, and it's an IRS predetermined amount based on your age. And what it basically is, at a specific age, when you have qualified money in a tax-deferred vehicle such as an annuity, the IRS says you got to start pulling some of those dollars out every single year because we want our tax money on that. And really, they know you're going to die soon, so they don't want you to get out of here without them getting their tax dollars paid on those monies.
Sure.
So current age for required minimum distributions right now on IRA money, qualified money, pre-tax money is 73. You do have to start withdrawing, and if you don't do that, you will be penalized. Again, that's an IRS deal. Eventually, they're going to bump that age from 73 to 75, and that's going to change in 2033.
Yeah, it'll be 75, you said, in 2033.
Correct.
Yeah.
Yep.
Awesome. All right. Well, again, thanks so much for doing this interview today, talking a little bit about just how annuities are treated from a tax standpoint. Any other thoughts that you have that we didn't touch on in this quick video?
I definitely think it is important to be educated on your, different opportunities in terms of vehicles to use for your safe money in retirement. And so if, there are additional questions on any of this, like Jamie said, put your questions in the comments or reach out to Jamie so we can help you figure out, a plan for yourself.
Yeah.
For your safe money.
Yeah, awesome. Well, thanks so much for watching this video. Again, feel free to reach out if you have questions, or you can even leave them in the comment of this video, and we'll see you in the next one.